Hi, in this video, we'll be looking into problem number 5. Problem 5 has appeared in the November 2018 exam for 5 marks. Sun Limited requires rupees 100 lakhs. Choice 1, 100% equity. Choice 2, equity of 25% and debt of 75%. Interest rate on debt is 12% per annum. Tax rate is 30%. Equity share of rupees 10 each, issued at a premium of rupees 15 per share. Expected earnings before interest and tax of rupees 40 lakhs. You are required to 1. Calculate the EPS in each of the plan, and 2. The financial break-even point, and 3. The indifference point between plan 1 and plan 2. So there are 3 requirements to this question. Out of the 3 requirements, the second one is new to this question, where we're asked to calculate something they call as financial break-even point. We'll look into what that means. But the other 2 are pretty straightforward. We know how to calculate EPS in each plan, and we also know how to calculate the indifference point. We've seen the indifference point coming in problem number 2 and also in problem 4. So let's quickly look at the requirement. So here in this case you have an investment of 100 lakhs, so you require financing for 100 lakhs, and you have 2 choices here, 2 plans, 2 choices. Choice 1 talks about 100% equity, and you have choice 2 that talks about a mix. You have 25% equity and you have 75% debt. So now let's go ahead in answering the requirements of the question. Let's first go ahead with the first requirement, which is the EPS in each of the plan. That's going to be pretty straightforward. That's the first requirement, EPS in each of the plans. Okay, so particulars, plan choice, I just keep using them interchangeably here. Plan 1, plan 2. EBIT. Whatever is the plan, our EBIT is going to be 40 lakhs. Minus interest. If it's going to be plan 1, there is not going to be any interest because no debt. If it's going to be plan 2, there is going to be interest. And how is that interest calculated? We have 100 lakhs of financing required, and out of the 100 lakhs, we have 25 lakhs coming in the form of equity. We have 75 lakhs coming in the form of debt. On this 75 lakhs, I need to apply 12%. This is the calculation for the interest. So it is 75 lakhs into 0.12, 12%. So that gives me 9 lakhs. So the interest cost that's there in the second plan is 9 lakhs. And I have earnings before tax. For the first plan, it's going to be 40 lakhs. And for the second plan, it's going to be 31 lakhs minus tax. Here they say tax rate is 30%. So for the first plan, I think it's going to be 12 lakhs. And for the second plan, it's going to be 31 lakhs into 30%. That's going to be 9 lakhs 30,000. So you will have earnings after tax, and that's going to be, for the first case, it's going to be 28 lakhs. And for the second case, it's going to be 21 lakh 70,000. So it's 31 lakhs minus 9 lakh 30,000, 21 lakh 70,000. Okay. Now, you don't have any preference dividend business here at all because we don't talk about any preference shares coming inside. So we directly divide this by the number of shares to get the EPS. So if you look into the first plan, plan 1, they tell us that, I mean for both plans, when they issue shares, they tell us that every share of rupees 10 is issued at a premium of 15 per share. So issue price of every share happens to be rupees 25. So in plan 1, you're going to have 100 lakhs and you're going to raise that through shares, issuing each share at 25. So 100 lakhs divided by 25. So that's going to give us 4 lakh shares. So it's going to give us 4 lakh shares for plan 1. When you look at plan 2, you're going to have 25 lakhs coming in the form of equity, and that's going to be through 25 rupees shares. So that's going to be 1 lakh here. So you have 4 lakhs and you have 1 lakh. Now EPS for plan 1, it is going to be 7 rupees, and for plan 2, it is going to be 21.7 rupees. It's going to be 21.7 rupees for plan 2. So we started with EBIT, we subtracted interest, and we have EBT, we subtracted tax, we have EAT, we divided that by number of shares, we got the EPS. So this answers the first requirement of the question. Well, they just asked us to calculate EPS, but based on that we can obviously decide that the second plan seems to be the best, at least at this level of operating profit. Now let's go to the second part. Let's go to the second part, which is the financial break-even point. Let's understand what is the financial break-even point. Financial break-even point. Now, break-even point, if you look at break-even point is a place where you have enough profits, just to cover your fixed cost. Enough profits just to cover fixed costs. So basically, if someone operates at the break-even point, the net profit that they have is going to be zero. That's mainly because you get some level of profits, and that level is just enough to take care of your fixed costs. So after taking care of fixed cost, you're not going to have any further profits left. So if you have profits just to take care of your fixed cost, that's called as that level of profits is called as the break-even point. Basically, after fixed costs, you should have zero profit, zero loss. This is the break-even point. Now, what is financial break-even point? You are talking about financial break-even point refers to that level of profits which just takes care of fixed financing cost. And after covering the fixed financing cost, you have nothing left. That is what is called as the financial break-even point. So let me tell you that financial break-even point takes care just of the financing fixed cost. So after the financing fixed cost, you have nothing left. That is what we call as the financial break-even point. Now, the first question before that is, what do I mean when I say profits which take care of financing cost? The moment I say profits that take care of financing costs, immediately what should come to our minds is EBIT, because it is only from this level of profits, it is only from EBIT that we start addressing the fixed cost. Only from EBIT we subtract interest is a fixed cost, and later we subtract preference dividend, that is a financing cost. Right? I'm sorry, financing cost. Only from EBIT we start subtracting financing cost. Interest is a financing cost, preference dividend is a financing cost. So if I say profits that take care of financing cost, immediately the level of profit that must come to your mind is your EBIT, which is what we call as operating profits. So if you have operating profits which are just sufficient to take care of your financing fixed cost and leaves you with nothing more, then that level of EBIT is what we call as the financial break-even point. So the concept of break-even point remains same here. So we said break-even point was that level where you had enough profit just to cover your fixed cost. But here also we are talking about fixed cost, but we're talking about financing fixed cost, and hence you call it as financial break-even point. Earlier probably we looked into operating break-even point where we were talking about operating fixed cost. So probably the level of contribution, that if you recollect the income statement, again we did this in the leverages discussion, if you recollect the income statement as sales, you have variable cost, you have contribution, then from that you subtract operating fixed cost, and then you have your operating profit. So a level of contribution which is just enough to take care of the operating fixed cost is called as the operating break-even contribution. The level of sales which is just sufficient to take care of the operating fixed cost is the break-even sales. At that level, those levels of profits will just take care of the operating fixed cost, will not give you anything more. So that was called as operating break-even point. Here we are talking about a level of profits which would just be sufficient of taking care of a financing fixed cost. So we call this as financial break-even point. And what profits would take care of financing cost? EBIT. So if I put all this discussion together, then I can say financial break-even point is a point where the EBIT is just sufficient to take care of financing cost. It's just sufficient to take care of your financing fixed cost. So that level of EBIT is what we call as a financial break-even point. So they're asking us in plan 1, in plan 2, what is the financial break-even point? Now, if I take plan 1, there is no financing fixed cost at all. There is no financing fixed cost at all because in plan 1 there is no debt. Debt has a fixed cost, debt has a fixed financing cost, but in plan 1 there is no debt at all, so there is no fixed cost. So that means if it's enough, if I need profits, if I need operating profits just to take care of my financing fixed cost, then I actually don't need anything because I don't have any financing fixed cost. So the financial break-even point, let me call this FBP. The financial, let me abbreviate this as, financial break-even point, FBP. The FBP for plan 1 is going to be 0 because I don't need, if I'm thinking only of operating profits to take care of my fixed financing cost, when there's no fixed financing cost, I don't need anything at all. So this is the 0 is the financial break-even point if the financing is all equity financing. This is always going to be true. If your financing is going to be all equity, then your financial break-even point is going to be 0 because there is no fixed cost financing in nature that you need to take care of. But when I come to plan 2, that's not going to be my logic. In plan 2, I have rupees 9 lakhs as my fixed financing cost. In plan 2, I have 9 lakhs as my fixed financing cost. Let me call this as FFC. A lot of abbreviations, but yeah, fine. I know you understand. FFC, financial fixed cost. So in plan 2, I have 9 lakhs to cover. So if I need operating profits just to be able to cover this 9 lakhs, then my EBIT must also be 9 lakhs. So if I have EBIT of 9 lakhs, it just takes care of my interest of 9 lakhs. After that, it gives me nothing. So the FBP, the financial break-even point for my plan 2 is going to be 9 lakhs of EBIT. Is going to be 9 lakhs of EBIT. If I have 9 lakhs of EBIT, I just have enough to take care of my interest. I don't have anything more. So that is the meaning of financial break-even point. So understand what a break-even point is and apply it in the context of a financing fixed cost and take the level of profits appropriately. That would answer your question. So intuitively you can answer this, right? There is no requirement to have any formula in place. Intuitively you can understand, you can address these type of questions if only you're clear with the concept behind what they're actually asking. Right? So this was the second part of the question. Now let's go to the third part where they ask us, our friend is back, indifference point. Right? So it's third part of the question, indifference point. Well, what is an indifference point? It is the level of EBIT. It is level of EBIT where plan 1 is equivalent to plan 2. So you're indifferent between plan 1 and plan 2, choice 1 and choice 2. One plan is as good as the other one. So that level of EBIT that makes that happen is called as the indifference point. But what do we know about indifference point? Why do I call it indifference point? Because at this point I know EPS of plan 1 must be equivalent to EPS of plan 2. So this also needs to hold true. So let me see how this calculation needs to be done. Okay, so I'm now going to do, I'm going to find out the EPS of plan 1 and EPS of plan 2 by way of an equation. So let us assume that the indifference point, the EBIT, which I can call as indifference point, let me assume that to be a variable x. Let me assume that to be a variable x. I don't know that. X is, let's say I'm talking about plan 1 here and I'm talking about plan 2 here. Okay. X is my EBIT. I start with X for plan 1. From this, I subtract 9 lakhs. I subtract 9 lakhs, which is interest. So EBIT minus interest gives me EBT. From this, I will be paying tax. What is the tax I will pay? 30%. So what remains with me as EAT is going to be 0.7 into 0.7. So this number into 0.3 would have been the tax. So this number, this into 0.7 will be the earnings after tax. No question of preference dividend. So this amount is directly available to all my shareholders, and I know here I have 4 lakhs of shares. So if I divide this, this is the EPS of plan 1. This is the EPS of plan 1. So start with the EBIT, subtract interest. So what you have in the bracket is the EBT. So you will pay 30% on tax. So if you take out tax, what remains is after tax. That is called as EAT, earnings after tax. So hence I multiply with 1 minus tax rate, 0.7. Let me write this here, 1 minus tax rate, 0.7. Now I have earnings after tax in the numerator, no preference dividend, so that also becomes my PAES. If I divide that by number of shares, which we saw, that was 4 lakhs in plan 1. So this gives me the EPS of plan 1. Let me go ahead with the calculation of EPS for plan 2. Again, I start with the variable X because that's my EBIT, which I'm going to calculate and find out. But here, in this case, I have a debt amount in plan 2. Well, I'm sorry, I made my bad here. There is, here in plan 1, there is no debt. I'm sorry, my bad. So, X minus 0, which is the interest, the entire thing into 0.7. So earnings before interest and tax, debt interest is 0, and because there's no debt in plan 1, sorry, that was a silly mistake, into 0.7 divided by number of shares, no preference dividend, so nothing else to be done here, divided by number of shares, that's going to be 4 lakhs. So this is EPS of plan 1. Now when I come to plan 2, X is the EBIT minus 9 lakhs. This is going to be the earnings before tax into 0.7. This will give me earnings after tax. No preference dividend, so nothing else to be done. So this earnings after tax also becomes PAES divided by, I know there's 1 lakh. I know it's going to be 1 lakh. So this is the equation for EPS for plan 1, and this is going to be the equation for EPS for plan 2. Now I know, since this X is the indifference point, EPS of both plans have to be equal. So now this is an equation that if I solve for this equation, I'm going to be getting the value of this X, and that's what I will call as the EBIT number, and that becomes the indifference point. So now let's go ahead and solving this equation. So 0.7x divided by 4 lakhs is going to give me 0.7x minus, this is, I think it's going to be 6 lakhs 30,000 divided by 1 lakh. Now if I multiply the right hand side by 4, numerator and denominator, so I can cancel out the denominators. So I'll say 0.7x is equivalent to 0.7 into 4, that's going to be 2.8. 2.8x minus, now 6,30,000 into 4, that's going to be 25 lakhs 20,000. That's going to be 25 lakhs 20,000. Now, so this is something I need to solve for. So let me go to the next page here. So I can start with this. 0.7x is equivalent to 2.8x minus 25 lakh 20,000. So if I bring 25 lakh 20,000 to the other side, then 2.8x minus 0.7x. So which would mean 25,20,000 is going to be equivalent to 2.1x, which would mean x is going to be 25,20,000 divided by 2.1. So 25,20,000 divided by 2.1. So that's going to give me 12 lakhs. 25,20,000 divided by 2.1, that's going to give me 12 lakhs. So in our discussion here, in this case, 12 lakhs is going to be the indifference point. So if 12 lakhs is the EBIT, then plan 1, choice 1 is going to be as good as choice 2, right? For any level of profit which is lesser than 12 lakhs, plan 1 might be better. For any level of profit greater than 12 lakhs, plan 2 would be better. That's why we saw 40 lakhs as the EBIT level, which is much higher than this one. So in that case, we see plan 2 to be much better for us, right? So this answers the third part of this question. So yeah, we have successfully answered all the three parts of the question. So what you've learned new in this question is just the calculation of financial break-even point and the logic behind that. Okay, so in the next videos, we'll look into the other problems in this topic area.